Welcome to Talk Tickers. Today we're diving into the latest earnings call from United Parks and Resorts, looking at their first quarter for 2025.
That's right. And, at first glance, the numbers show a bit of a dip compared to last year.
Yeah, revenue and attendance both down a touch, but I get the sense there's more to the story here.
Definitely. So first quarter revenue came in at $286.9 million. That's a decrease of $10.5 million, or about 3.5% year over year.
Okay. And attendance?
Attendance also saw a slight drop, about 59,000 guests, which works out to 1.7% down from Q1 last year.
Right, but you mentioned nuances. What's underneath those headline numbers?
Well, the big one is the timing of Easter and, spring breaks. This year, that peak period shifted fully into the second quarter.
Ah, okay. So Q1 last year had that benefit, Q1 this year didn't.
Exactly. And if you adjust for that calendar shift, the company estimates attendance would actually have been up around 2%.
That's quite a swing. So the underlying trend might be positive then.
It seems that way. If you look year to date through April, physical attendance is up about 1.3%. And even better, on a sort of day-to-day operational basis, it's up over 3%.
And April itself, I heard that was strong.
Very strong. April 2025 attendance was up 8.1% compared to April 2024, a really significant jump.
Okay, so that Easter shift really did mask some underlying momentum, it seems. What about spending? How much are people spending per visit?
That's another interesting mix. Total revenue per capita, so total spend per guest, that actually decreased by 1.8%.
Down 1.8. Okay. Where did that decrease come from?
Primarily from admission per capita, that was down 4.2%. Maybe some sensitivity to ticket prices, perhaps?
Maybe. But what about once people are actually in the parks?
That's the good news. In-park per capita spending, it increased by 1.1%. And get this, it hit a new record level.
A record. Wow.
Yeah, that's growth for 19 of the last 20 quarters for in-park per caps. And importantly, that positive trend continued in April too.
So people might be watching the initial ticket cost, but once they're inside, they're opening their wallets for food, merch, experiences.
Precisely. It suggests, pretty resilient consumer behavior once they commit to the visit. That pricing power inside the park is key.
Okay, let's shift to profitability then. How did the bottom line look for Q1?
Well, the company reported a net loss of $16.1 million for the quarter.
How does that compare?
It's a wider loss than last year. Q1 2024 saw a net loss of $11.2 million.
Okay, and adjusted EBITDA. That's a key metric investors watch.
Right. Adjusted EBITDA came in at $67.4 million. That's a decrease of $11.7 million compared to the first quarter of last year.
So a bigger loss, lower adjusted EBITDA. What's driving that beyond just the lower revenue from the calendar shift?
Well, the revenue decrease is part of it for sure. That shift took peak days, like you said, out of Q1. They estimate the negative attendance impact alone was around 140,000 guests just from that timing.
Okay, significant. Any other factors on the cost side?
Yes, there was also some timing stuff with expenses. They recorded over $5 million more in certain expenses in Q1 this year versus Q1 last year.
$5 million. What was that from?
It was a couple of things. About $3 million was annual maintenance. They apparently shifted some of that work, usually done in Q4, into January and February this year because those are slower months. Makes operational sense, I suppose.
Okay, so pushing maintenance costs forward into Q1. What was the other $2 million?
That was roughly $2 million related to some marketing spend timing shifts from late last year. Plus, they had some non-recurring credits in Q1 of 24 that just didn't repeat this year.
Got it. So a combination of the Easter shift hitting revenue and some specific expense timing impacts hitting the bottom line in Q1.
Exactly. It paints a picture of why Q1 looks softer than maybe the underlying business suggests.
Which probably explains why, despite those Q1 numbers, management is reiterating their expectation for a record year overall in 2025. Record revenue and adjusted EBITDA.
That's their guidance, yes. They seem quite confident. They point out that as of April 30th, roughly 75% of their historical attendance and revenue opportunity for the year is still ahead of them.
So what's fueling that confidence for the rest of the year, beyond just the calendar shift unwinding?
A few key things. First, that strong April performance we talked about provides a good launch pad. Second, they have a really packed lineup of new rides and attractions opening up.
Right, tell us about those.
Yeah, quite a list. There's Jewels of the Sea and the revamped Journey to Atlantis in San Diego, Rescue Junior in San Antonio, Expedition Odyssey just opened in Orlando on May 9th.
Expedition Odyssey. That's the one with animal components, right?
That's the one, yeah. Then you've got the Big Bad Wolf Coaster, the Wolf's Revenge at Busch Gardens Williamsburg, High Tide Harbor at Water Country USA, and Wild Oasis at Busch Gardens Tampa Bay. So lots of new draws across the parks.
A lot of capital going into new experiences. What about other strategic initiatives? Are they still talking hotels?
They are. Discussions continue about integrating branded hotels, but no specific updates on that front in this call.
Okay. But they did talk quite a bit about real estate, didn't they?
Oh, absolutely. This seems like a growing focus. They own over 2,000 acres total and highlighted about 400 acres of undeveloped land right next to their existing parks. Apparently, a significant chunk of that is near the Orlando parks.
400 acres of developable land. That's substantial.
It is. And management was pretty clear they believe the public markets aren't giving them credit for the value of this real estate. They're actively looking at ways to, quote, unlock its value potentially with partners.
Interesting. So looking beyond just the park operations for value creation, what else strategically?
Sponsorships. They've put a formal structure and dedicated team in place now to really go after sponsorship deals, leveraging their, 21 million annual visitors and customer database.
What kind of numbers are they targeting there?
They think it can exceed $20 million over time. For this year, 2025, they're expecting something in the mid to high single-digit millions. And apparently, the reception from potential sponsors has been quite positive so far.
Okay, that could be a nice incremental revenue stream. Anything on the international front?
Discussions are ongoing with multiple potential partners in different geographies. International ticket sales right now are up low single digits year over year.
What percentage of attendance is international now?
It's running about 6-7%. Pre-COVID, they mentioned it was closer to 10%, so there's still room to recover and grow there.
Got it. And IP partnerships, still pursuing those?
Yep. Active discussions continue to bring some globally recognized IP into the parks. Plus, the usual stuff, ongoing park enhancements, investments in technology like their CRM and mobile app to, improve the guest experience and drive growth.
Sounds like a lot of levers they're trying to pull. Let's talk balance sheet and capital returns. How are they looking financially?
Pretty solid. Net total leverage was 3.1 times at the end of March. They've got good liquidity, around $764 million available, including $76 million in cash on hand.
And share buybacks. I saw they repurchased some shares.
They did. About 100,000 shares in Q1 for roughly $4.6 million. And the commentary around this was notable.
How so?
Both management and the board stated pretty strongly they believe the shares are materially undervalued right now. The board is apparently working through governance and other things, but hinted at potential future announcements on buybacks in the coming weeks.
Okay, so a clear signal they think their stock is cheap and might be getting more aggressive with repurchases. Investors usually like to hear that.
Definitely something to watch.
Let's circle back to that April performance. You said attendance was up sharply. Did that translate into spending too?
Yes, the positive in-park per capita spending trend continued in April. Admissions per capita, while maybe not positive year over year in April, apparently showed better performance than it did in the first quarter overall.
So the dip in admission spending might be moderating a bit.
Seems like it. And the continued strength in in-park spend suggests, no major pullback from consumers once they're actually enjoying the park.
Okay, so pulling it all together, the April rebound, the new attractions, the peak pass selling season still ahead, these strategic initiatives like sponsorship starting to ramp up. That's the basis for their confidence in hitting record results this year.
That's the narrative, yes. They also mentioned anticipating more normalized weather compared to last year, which apparently had some hurricane impacts. And interestingly, they view the new competition coming online in Orlando.
You mean Epic Universe?
Right. They see that as potentially driving more visitors to the Orlando market overall, which they aim to capture a piece of. They feel their offerings, especially with unique elements like the animals in Expedition Odyssey, are differentiated enough.
So they're not necessarily seeing it as purely a headwind, but maybe an opportunity to benefit from a bigger pie.
That seems to be their public stance, yeah. They believe their value proposition is strong, and they have levers to adjust pricing and offers if needed.
What about managing costs? You mentioned some timing issues earlier, but overall?
They seem pleased with their cost management, particularly on the costs that feed into Adjusted EBITDA. They acknowledged labor cost pressures from minimum wage increases and just competition for workers.
Which everyone's facing.
Right. But they say they've largely offset that through better hourly labor management and more accurate attendance forecasting.
And marketing spend, is that going up with all the new attractions?
Plan to be relatively flat for the year, actually, but they're redeploying it, shifting dollars around strategically between different markets and channels.
Okay. And the pass program. That's usually a key driver.
Yeah, the pass space was down slightly, about 2% in March compared to the prior year. However, they are seeing realized price increases, particularly on their premium pass tiers.
So maybe fewer pass holders, but the ones they have are potentially paying more.
That seems to be part of it. And they really talked up their current pass benefits program, calling it the best ever. And they expect that to drive more sales and build back the pass space of the year.
All right. Anything else notable on spending? CapEx?
They spent $56.9 million on capital expenditures in Q1. Most of that, about $50 million, was core maintenance and improvements, with around $7 million on expansion or ROI projects like the new rides.
And the plan for the full year?
Expected to be between $175 and $200 million for that core CapEx, plus an additional roughly $50 million earmarked for those growth and ROI initiatives.
Okay. And just quickly, group bookings. How's that segment looking?
They said the group business category feels good with continued growth opportunities there.
Right. And that sponsorship revenue you mentioned, just to clarify, that wasn't really baked into Q1 much, was it? That's more upcoming.
Correct. They indicated the significant ramp up in sponsorship revenue is still ahead, so not a material contributor to Q1 results yet.
And one last thing on the strategy side, that real estate and potential hotel development, are they thinking just hotels? Or other uses for that land?
It seems like they're considering various options. Hotels, yes, but also potentially housing, other complementary attractions. They're looking at different structuring options too. Maybe things like leasebacks, trying to find the best outcome for shareholders. Discussions are ongoing with various potential partners, and the board is actively involved.
So definitely an active area, even if no concrete deals announced yet.
Seems that way. Lots of moving parts.
Okay, so if we step back and think about how investors might view all this, the market reaction is probably going to be a bit torn, right?
I'd imagine so. You have the weaker than expected Q1 results, the net loss, the lower adjusted EBITDA. That's the immediate negative takeaway.
But then you have the company strongly reaffirming guidance for a record year.
Exactly. And they're pointing to tangible things like the strong April data, the new rides, the initiatives. So investors will be weighing that Q1 performance against the optimistic outlook.
The April attendance and particularly the in-park spending figures will be crucial proof points then, showing if that Q1 weakness really was just timing.
For sure. And progress on those strategic initiatives, especially locking down some value from that real estate or announcing significant sponsorship deals, those will be watched very closely as potential catalysts.
And the commentary around share buybacks, the board thinking the stock is undervalued. That signals potential capital returns down the line, which should support the stock.
Right. It shows conviction from insiders. And finally, how they navigate the new competition in Orlando. Can they actually benefit from increased tourism as they suggest? That's a key question mark.
Okay, lots for investors to digest there. Now let's move to our favorite segment. This is not financial advice. Based on this earnings call, what's an outrageous but plausible trade idea you've cooked up?
All right, buckle up. Given all the talk about new competition driving more people to Orlando and United Parks believing they'll capture their share, how about this? The tourist surge play. Forget trying to pick the winning theme park directly. Instead, consider going long on companies that benefit from more people being in the Orlando area, period. But not the big park operators themselves.
So, who does that leave?
Think, local transportation, maybe specific rental car companies with big Orlando exposure, or even looking at ancillary service providers. Think smaller, maybe off-site hotels, local restaurant groups not directly tied to the main tourist corridors, maybe even certain local entertainment or service businesses that could see spillover traffic.
So betting on the rising tide, lifting the boats around the main attractions rather than the main attractions themselves.
Exactly. It's a bet on the overall economic boost to the region, diversifying away from the direct theme park dogfight. That's idea one.
Okay, interesting angle. What's idea number two?
Idea two leans into that real estate angle we discussed, the hidden asset unlock hedge. Management sounds convinced their land is undervalued and they're actively working to unlock it.
Right, the 400 acres near Orlando, potentially worth a lot.
So, consider a pairs trade. Go long United Parks and Resorts. But simultaneously, short a comparable entertainment or theme park company that doesn't have such significant, clearly articulated, undeveloped real estate potential.
So you're trying to capture the potential upside if United Parks does unlock that real estate value while hedging out some of the general theme park sector risk.
Precisely, the outrageous part. You're essentially making a bet that a theme park company temporarily acts more like a real estate play. It's wagering that the land value narrative could, for a time, become a major driver for UPR, independent of just attendance figure.
Betting on dirt overrides, essentially. Definitely unconventional.
That's the goal of the segment, right? Outrageous but plausible.
Absolutely. And let me stress again for everyone listening, these are just creative thought experiments, absolutely not financial advice. Please do your own extensive research before making any investment decisions.
Couldn't agree more. Due diligence is critical.
So, wrapping up our deep dive on United Parks and Resorts. It really is a mixed picture in the short term, heavily clouded by those Q1 timing issues.
Yeah, the calendar shift and expense timing definitely impacted the quarter. But management's confidence, backed by the April rebound, new attractions, and those strategic plays like real estate and sponsorships, it paints a compelling forward-looking story.
It does. There's a clear path they're articulating towards that record year, even if Q1 didn't show it. The potential for value unlock from non-core assets adds another layer.
Lots to consider. It'll be fascinating to see how the rest of the year unfolds for them, especially with the Orlando market heating up.
Indeed. Well, that covers our look at the United Parks and Resorts call. Remember, this was a high-level overview based on their presentation. We encourage you to dig deeper into the company's filings for the full details. What are your thoughts on their strategy? We'd love to hear your perspectives.
Thanks for tuning in to Talk Tickers. We'll be back soon with insights from another earnings call.